All right, let's dig into Hamilton Lane's fiscal second quarter 2026 earnings. And I'll tell you, this wasn't just another good quarter. No, this was a statement quarter, one that really got the market's attention. And we're going to break down exactly why.
So where does the story of this quarter really begin? Well, it all kicks off with one number, plus 42 cents. That's how much Hamilton Lane's non-GAAP EPS absolutely crushed analyst expectations by. We're not talking about a squeaker here. This was a massive surprise that really set the tone.
And you know what? The market noticed. Big time. The stock shot up 6.4% on the day. And what's really important is that this happened on way higher than average volume. This wasn't just some quiet upward drift. This was investors making a big, confident move, basically screaming that they loved what they saw.
So let's break down the numbers that got everyone so excited. It was a clean sweep, a solid beat on both revenue and earnings. Non-GAAP EPS came in hot at $1.54, just blowing past estimates. Revenue beat by about 10%. But the real story here, the number you really need to pay attention to, is fee-related earnings, or FRE. It jumped 37% year over year. That's the company's core, recurring profit engine. And folks, it is absolutely firing on all cylinders.
Okay, so a huge beat pushed the stock up today, but what about tomorrow? What's the next big thing that's going to drive this story forward? Well, that brings us to the single biggest piece of news from the call, a game-changing strategic partnership with Guardian Life. This thing could reshape the company's entire growth trajectory.
And listen, this isn't just some standard client deal. This is a deep, multi-layered partnership. So first off, Hamilton Lane is taking over the management of Guardian's existing $5 billion private equity portfolio. Then, Guardian is committing to invest around $500 million every single year for the next decade. On top of that, $250 million of that capital is going to be used to seed and accelerate Hamilton Lane's super important evergreen platform. And to cap it all off, this deal blows open a massive new distribution channel, Guardian's network of 2,400 financial advisors.
So what's the bottom line here? It's simple, really. This partnership gives them a brand new, super durable way to grow their assets under management. It turbocharges their push into two really valuable areas, insurance and private wealth. It's not just a one-time boost, it's a long-term growth engine.
Now that Guardian deal, that's all about the future. But we can't forget about the here and now and what powered this quarter's incredible results. It all comes down to the sheer strength of their existing core business. I mean, just look at this. Fee-related earnings soared 37% compared to last year, hitting $77 million for the quarter. This chart right here, it's basically a health report for the company. And folks, the results are fantastic. This is the strong foundation that lets them go out and make these game-changing deals like the one with Guardian. And it wasn't just one thing either. The strength was everywhere you looked. Assets under management, or AUM, were up 11% to $145 billion. Their total asset footprint, it crossed $1 trillion for the very first time. Plus, they're sitting on a massive $1.4 billion unrealized carry backlog. Think of that as a huge pool of future profits just waiting to be tapped. Throw in a dividend hike on track for 10% growth, and yeah, the whole machine is just humming along beautifully.
Okay, we've mentioned this evergreen platform a couple of times. It's so important to understand what it is. These are basically semi-liquid funds that make it way easier for individual investors through their wealth managers to get into private markets. And the momentum here is just wow. They had a record $1.6 billion in net inflows this quarter alone, and they've nearly doubled the platform's assets in just the last 18 months. Incredible.
You know, it wasn't all just about the stellar numbers on this call. Management took the opportunity to go on the offense and directly tackle a negative story that's been floating around out there in the market. Co-CEO Eric Hurst got right to the point on the fears about a so-called private credit crisis. He said, and I quote, "We see no data to support this notion. This is the power of having actual data and not living and prognosticating via anecdotes." Speech over. Yeah, a total mic drop moment pushing back against fear with cold, hard facts. And they didn't just say it, they showed their work. So on one side, you have the market narrative, this general fear of a private credit crisis. But on the other side, you've got Hamilton Lane's reality, pulled from their own massive database. And it shows that in their portfolio, leverage is prudent, interest coverage is healthy, and default rates are really low, around 1%. They're using their data as a competitive advantage, and it's powerful stuff.
All right, so let's wrap this all up. We've got a monster quarter, a game-changing partnership, and a management team that is clearly confident and armed with data. So where does that leave us as we look forward? It's time for the next call. So if you're watching this stock, what are the key things you need to keep an eye on? First, you got to watch for that Guardian deal to close in the fourth quarter. That's when the revenue starts to kick in.
Second, keep your eyes glued to that evergreen platform's momentum, especially since fee holidays are about to roll off on $1 billion in assets. Third, look for them to start realizing some of that huge $1.4 billion carry pool. And finally, don't sleep on their data and tech business, especially with new partnerships like Bloomberg.
Okay, here it is, the final verdict, our call on Hamilton Lane. For the next quarter, we expect to see continued strength in fee-related earnings driven by that evergreen platform, with the first bits of the Guardian impact starting to layer in. As for the stock, we think the market still hasn't fully priced in this superior long-term growth story. There is absolutely room for this stock to re-rate higher. So, putting it all together, our official rating is outperform.
And as always, a final reminder, this is not financial advice.